Louise Bedford here, the host of the Talking Trading Show, and this is our final episode for 2023, which is quite a big occasion. We have had a huge year. We are going to talk about what has happened during the year. And to help me do just that, I have my business partner of 26 years that I'm going to interview, Mr. Christopher Tate. Christopher, welcome to the show.
Thank you. I'm back again. It's amazing. How many times is that this year?
Quite a few. We've looked at market wraps together, psychological principles that govern trading, and I've even done some trading plan reviews live so that people can benefit from me reviewing somebody's trading plan. Now, I have to say, you're the best-selling author of The Art of Trading. You are my business partner, the co-host of our mentor program that we've been running for the last 23 years. Coming up is our 24th year of running the mentor program, and I would say we know each other pretty well. So I am interested to hear how you're going to surprise me with your views about the markets over this last year. So what do you feel have been some of the biggest themes for the year?
Good question to start with. Let me default to PowerPoint because PowerPoint is everybody's friend. So I will just share my screen because these things make much more sense when you can actually see what's going on.
And for everybody listening, it's really important to see this video as well. So there's two ways to do that. You can come to youtube.com/trading game, or you can also go to talkingtrading.com.au, which is our Talking Trading website, and look in the show notes for this particular episode, because we'll always pop the video when we make a video in those show notes. What do you see here, Chris?
So markets this year have been really interesting because there is such a dichotomy between them. And what I've done here is I've ranked major indices based on their year-to-date performance. That is starting from January 1 through to the date we record this. And there are three standouts. And the three standouts are the FANG, which is not really an index. It's more an aggregation of technology stocks. And I'll have a bit to say about that in a moment. Quite naturally, because they're a driver of the NASDAQ 100. The NASDAQ 100 has had exemplary performance. But what is surprising is the Nikkei. The Nikkei is closing in on a 34-year high, having gone nowhere for a generation, and literally a generation. Those of us who are really old can remember the extraordinary performance of the Nikkei during the 1980s, when it seemed like it was going to be the Japanese century. That completely evaporated with their massive asset deflation. And of course, there is us almost bringing up the rear with a year-to-date gain of 1.1%. The only positive thing I can say about that is that once again, we beat the POMs. And that's always the most important thing in anything. But the other thing is to look at is how mediocre the Dow was. The Dow has had this bull market that's been almost a generational bull market. And this year it began to struggle. And it began to struggle because that very narrow index of stocks that is the Dow 30 began to struggle. It shows you the problems of following a very narrow index. And the Dow is exceptionally narrow. But I did say I wanted to mention something about the FANG stocks. And the thing to note is that my view, and the view of everyone else, is that the American market is being driven by 7 stocks and only 7 stocks. So any movement you see in the S&P 500 or in the NASDAQ 100 is being driven by Tesla, Amazon, Microsoft, Alphabet, which is the former Google, Nvidia, Apple, and Meta, which was Facebook. They're the drivers. And some clever clogs has actually put this into context for us because everything is context. And these are the indexed returns of both those 7 stocks, the S&P 500, and the remaining 493 stocks. You can see that the remaining 493 stocks in the S&P 500 contribute virtually zero to the S&P 500's performance for this year. So we have this odd market where the world's largest market is being driven simply by 7 stocks. It's a very, very strange situation, and one of the drawbacks of weighted indices. But it is what it is, and if you haven't taken advantage of it, well, then that's simply the way it is as well.
I think sometimes that's a good idea to drill down and see what's behind the results that you can see as evident, because in general terms, people would not realize that that is what is driving the market unless they look a little bit more closely.
Oh, no, that's a perfect point. If you were to speak to a stockbroker would simply present you with a chart of an index and say the index always goes up. Bullshit. The index might go up, but the stocks you own might not. And when you've got these very narrow drivers, you run the risk of simply being marooned in a market, in a sector, in a stock that is doing nothing. And one of the things that's important to remember is that the majority of returns for investors come from a tiny handful of stocks. And it is a tiny handful. I think the figure, if you look at worldwide indices, if you look at what drives their performance, it's about 4% of all world stocks do most of the heavy lifting. And that has been that way apparently since the 1920s. So the task is for people who are involved in equities, find those things that are moving and trade only those things. Don't get caught by this nonsense mantra that you just scattergun the market and you buy, hope and pray, because that unfortunately just means that you get stuck with instruments that go nowhere. And the interesting thing about, if we cast the net wider, it's always good to look a little bit wider. If you look at the performance of commodities, you see something really interesting. You see that there's been exemplary performance in the top 3, orange juice, sugar, cocoa. And orange juice in particular is fascinating because we're just speaking about the NASDAQ 100. When you compare the performance of orange juice to a NASDAQ 100 ETF, orange juice actually trounces it, which is a surprise.
So really we seem to have a situation where if you have Cocoa Pops and orange juice for breakfast, you might be driving
well.
You might be driving this orange juice, sugar and cocoa redemption. Yes.
The other point I would suggest is that it flies in the face of the economists who say that people can't buy houses because they're having avocado on toast. I would suggest they can't buy houses because they're having orange juice and Cocoa Pops for breakfast, because the price of those must be going through the freaking roof at present. And this is again, we come back to this thing of you must know what you are looking for and looking at, because I would imagine the majority of people listening to this are completely oblivious to the fact that commodity markets exist and the commodity markets generate such returns. And because it is often this silly notion that commodities markets are simply for either gamblers or highly educated speculators or hedgers. And that's
I think it also gets back to the point when we have traders come to us in our mentor program, what we suggest is that they learn 3 instruments. So whether it be 3 different markets or 3 different time frames, that can actually give you some chances as well. But if you're looking to get rolling in the markets and do it so that you've always got something trending, that 3 seems to be the magic number. You could learn shares and CFDs and commodities, for example, or even include index trading, because then you'll have choices. You'll know those markets in all of their entirety before you trade them, and you can switch from one to another, that way managing that universe of trades that are going to give you a high probability result.
It comes back to the game that I play with some of the mentorees when they operate under the very, very mistaken assumption that you require some great level of skill or some special hidden knowledge to trade a commodity or an index or an FX contract. I put up a series of charts, I remove the name, and I say there's $1 million to anyone who can get all 5 right by telling me what they are. No one can, because they all look the same. The moment you take the name off something, unless someone is intimately familiar with it, then it becomes unidentifiable. These could be a comparison between 2 stocks, and you would not know. The only thing that tells you what they are is the name, and we'll see that when we look at a commodities contract or 2 in a minute. They all look the same. Price does the same thing. It must do the same thing because price is driven by people. All people are the same. So people's responses to the market are all the same. It can't be any different. And that, unfortunately, leads us to our market, which is, as usual, going sideways. This is the ASX 200. This is year to date. This is a daily chart to get a bit more information. And you can see that we are down. We have a marginal gain from when I snipped this to where we are today.
The thing with this, though, is that when we're looking to trade a sideways trending market, we do need to have a few rules around this. This sideways movement has been quite difficult for a lot of traders because we have a macro filter which tells us when we can trade and when we don't trade. And this macro has been turning on and then off and then on and then off almost for the entire year, which has allowed some of our traders to realize this quite early on and make sure that they break that upper resistance level before considering the Australian market as an appropriate universe for 2023.
And that's just this simply writ large. This takes us back to the COVID pop in 2020. And as you can see, for the past year and a bit, we've just gone sideways. And this comes back to a point I regularly make and which regularly irritates people, I know. And that is, in trading or investing, you should never make a statement without actually being able to back it up. Because unfortunately, the industry is full of, look, I don't want to call them mistruths, but it's full of half-truths, homilies, anecdotes, and basically stupid ideas. My view of the Australian market is that it is a special situations market. It is a market where you look for special situations within sectors and you trade those. And by trade, I mean trade. You take an active approach. 2021, it was lithium. Well, part of this year, it was uranium, but uranium seems to have petered out. Uranium stocks did do very well. Uranium ETFs did well. But again, it's a special situation. And the point I'll make, which I'll prove in a moment, is that the last true wide secular bull market that the Australian market had was 20 years ago, and it hasn't had one since. And we can see the relative performance of our market. This is versus the NASDAQ 100, the S&P 500. You can see we are a very ordinary performer, which is why when we've looked at specialist trades for our more advanced people, they've been on the NASDAQ 100. They haven't been locally based simply because the opportunities are not there. But I did make the point that the last bull market we had was 20 years ago. This is the All Ords, so it's all stocks within the All Ordinaries. This is the cumulative new 52-week highs, new lows. So it takes all the new 52-week highs and all the new 52-week lows, sums them, turns them into this line graph. The blue monolith in the middle is that 2003, 2007 bull market. And during that period, the Australian market was probably, of all the, let's call them advanced nations, the best performing market in the world. We outperformed the US. But since then, performance has been immensely mediocre. And we've not recaptured, by any stretch of imagination, that energy. Now, that doesn't mean that there are not opportunities. And I think this is the trap people fall into. They see something like this, they throw their hands up in the air and they go, well, it's all too hard. It's only too hard if you don't know where to look. And because we are a special situations market, if we look at the best performing shares year to date, if I looked at these and said, what is the underlying feature of these? The underlying feature is they're either a mining stock, because that's the nature of our economy, and they're speculative. These
So
are not, they're not investment grade by any stretch of the imagination. You're not going to buy this and get a 7% fully franked dividend return forever. But they still offer the capacity, if you know how to find them, but more importantly, manage them, for these outsized opportunities. And
So, for everybody who is listening to the audio, Chris has popped up a method of looking at the markets by looking at the year-to-date percentage change with the stocks that represent that percentage change. So it ranges from 3,441%, and the next one down is 1,722%, down to even 105%. And there's a chock lot of them right there that are making the 200% returns. It's just you do have to know where to look. So the market was actually moving, but in particular pockets.
And that's the thing, these match the returns of any market in the world for that segment of the market. The problem people face is they simply look in the wrong place because they're being told the wrong thing. And they don't know how to sift through the 2,000 odd stocks that the local market has, rank them accordingly, but more importantly, manage them accordingly, because it takes a different skill to get the most of what you would expect out of something like Wildcap Resources, as opposed to buying ResMed at the peak and holding it all the way down because people go, well, it's a good stock. You'd never buy a bad stock because you're not that stupid. So it must be a good stock. But yes, you are that stupid because you bought a stock that was going down and you don't know how to manage it. It's just the way it is. And I mean, if we have a look at Wildcap, which is the best of the year, there's a few things that become obvious. One is it's a little bit noisy, but that's the nature of these stocks. There's no way around that. But the other thing we note is that really simple methods, such as knowing how to trade a simple breakout from consolidation and knowing how to trade a gap, means that you can capture a large proportion of any move that they occur. Now, this is a noisy move, and they do require a methodology to trade. And by methodology, I mean you've actually got a plan. And a plan is not looking on some internet forum, listening to a 45-year-old who still lives at home in his mother's basement telling you what to do.
Or a 22-year-old.
Oh, that's the preserve of people who trade crypto. We'll put them in that basket. But if we look at, I consider this is cocoa. This is the contract traded out of the UK. And if we remember back to the early slide I showed of the performance of commodities, it doesn't quite have the year-to-date return of orange juice, but it offers something much more interesting. You'll notice how clean it is compared to Wildcat. It's a very, very clean chart. These sorts of clean charts offer tremendous capacity for pyramiding and loading up on positions so that you get the maximum from it, because they display this low volatility. Now, I'm going to have to correct people who will go, if it's gone up, it must be volatile. No, that's not how it works. Trend and volatility are not the same. Trend is speed and distance. How much and how far and how quickly does a stock price move? Trending is the propensity for prices to autocorrelate. The two are vastly different. And if you ever want to get an instant indicator that somebody knows nothing about trading, they will use the phrase, price is exhibiting downward volatility. Volatility is directionless. It can't move in any one direction in that respect. And this is a low volatility move with a high propensity for autocorrelation among prices. It trends. and it trends smoothly. There's no dramatic price shocks. Yes, there are some large reversal candles in there, but once you know what they mean in context, we always come back to context. This is a good move. But that leads me to what I consider to be the worst move of the year. Now, there are stocks that lost more. There are stocks that were completely belted and virtually disappeared. That's the nature of the Australian stock market. I consider this the worst because this is called Lithium, which was 18 months ago one of the darlings of the market. And it's one of the worst because it exemplifies people's tendency to cling to legacy trends, to look back at what was and say, well, lithium was really good. It must still be really good. Well, no, because it's lost 80% of its price. It's not really good. And I do understand people generate emotional attachments to things. But if you're still holding this from its high, you probably really deserve the malleting you've been given. And hopefully you've learned something from it so you don't repeat that expensive lesson. And yes, I know people will go, but it's only a paper loss. Yes, a paper loss is a loss without the taxation benefit of the loss. You've got to think these things through. So this exemplifies people's inability to let go of the past and their emotional attachment to things, and to recognise that when we talk about special situations, they come in waves. The time for this stock may come again. Nobody knows. But at present, it's a dog. And it began the year as a dog, continued as a dog, and really should be taken to the vet and put down. That's just the way it is. And if I want to look at things that were, to me, a profound disappointment, and given that, I'm a guest, I can talk my book if I wish, it's natural gas. And this is disappointing because it shows, this is actually how I see charts. This is snipped directly from what I see every morning. There's an old rule in trading, or it's a rule I have, in that breakouts from extended congestion are the best moves you're ever going to get, by far. Natural gas breaks out, I go long, it promptly stops. What the hell? Did it know that I had bought it? Did it know that it has not read the countless number of textbooks that went before that said, listen, digger, you've been in congestion for nearly a year. That means when you break out, and you break out solidly, you've got to go up. You can't go sideways. That's
Now,
not
although
good.
I don't know whether this particular chart will have heard you say that, Chris.
I'm quite certain
didn't
it
read
is,
the
and it's
rule
taking
book.
notes.
So one of the things that Chris is referring to here can also be thought of as the measure rule, where if something is going sideways for a particular length of time, you can flip that amount of sideways progression on its side so that you end up having, after the breakout, the same amount of increase in the price that it went as a sideways move when it was consolidating. So
Yeah, and that's basically, in part, you do sometimes have to reflect upon yourself and go, was I being too much of a clever clogs? Because natural gas had a tremendous fall that was very, very profitable. It simply fell out of bed from almost 10 down to where you sit at the base there at 2. It really took a belting very, very quickly and was a very, very profitable trade for those involved.
if you were short.
When you're short, and you then sit there watching the consolidation and go, okay, it's going sideways. I'm now going to repeat the reverse of that move, but on the long side, and they're super clever clogs. And of course,
apparently that wasn't going to
apparently that wasn't going to happen, because I believe it was von Clausewitz who said that no plan survives first contact with the enemy. And lo and behold, you get pinged out for a break-even trade and go, well, we'll reload, reset, and start again and just wait. But the thing it shows you is that, as the management bankers would say, you can have all your ducks lined up in a row and they still just fall off the wall and don't do what you think they're going to do. And this, we fall back to this notion that this annoyed me but didn't concern me simply because I had a plan for dealing with it.
And you're never going to get every trade right. There will
Pardon?
always be the perfect setup that you will enter according to your plan, and bang, it's not going to work. So, the thing that we need to remember as traders is that we are looking at weight of evidence. We are aiming to be completely detached and objective. We're taking the signals when they occur, we're managing the trade as it emerges, and really, if you're tying your own ego to one particular trade, you are doing it incorrectly.
That's the thing. That's the word ego. You have to have this capacity to go, I was right, I was right, I was right. No, I'm wrong. And you need to be able to undertake that emotional pivot shift and recognize that not everything goes in your favor and things go wrong. Trading is an imperfect endeavor. And so you need to be able to let go of any ego you have and just go, "Oh, it's just another one," which does bring me to my final chart for the year, because I thought I'd end on a positive note. This is the most surprising slash brackets stupid move of the year I've seen. And I say stupid not in terms of the block I've highlighted is this year. This is Vanguard's total bond fund. Now, a little bit of an education on bonds. When interest rates go up, the price of bonds come down. You can see the tightening cycle in the extreme left begin, and prices begin to collapse. Prices continue that collapse during this year. Worldwide, what was the cycle of interest rates? It was tightening. So therefore, it was inevitable that bond prices were going to fall. Why in God's name, during a cycle of tightening, are people either being recommended to buy a bond ETF that is a long bond ETF? And why are people falling into the trap of simply not going, well, interest rates are going up, bonds are stuffed, I will wait till the interest rate tightening cycle ends? And just when you think you've seen every stupid thing you could ever possibly see over nearly 4 decades of doing this, something new comes along and you go, guess what? They invented a better idiot. Now, I'm not talking. Now, there is a distinction to be made here. I'm not talking about bonds themselves, because people have many different reasons for buying bonds. Corporates use them all the time as a mechanism of funding, and so there are reasons they may be doing it. So this is not a bond itself. This is a fund that buys bond that people then buy it. So the only reason you would buy this is if you considered that the interest rate cycle had changed and interest rates were going to ease off and not squeeze the living daylights out of it. And there's been no evidence of that whatsoever. And what is intriguing is the first part of this graph. Interest rates are only going in one direction. It's the same here locally. Interest rates for, God, how many tightenings have we had now? It's difficult to lose count when your head's in a vice. That's not what the cycle is. So once again, they always invent a better idiot. Markets have that capacity. It's quite remarkable that they have this ability to draw out stupidity in people and for them to do this. This is the same as, let's use something that someone else might be more familiar with. This is the same as buying a gold ETF when the price of gold is collapsing dramatically for whatever reason. It's the same silliness. Now, granted, people obviously have their own reasons, none of them logical, sensible, or intelligent. But then that's often the way people approach things in markets. They approach them on an emotional basis as opposed to a logical basis. There is no plan in the world that says buy a bond ETF when interest rates are going up. None whatsoever. So that's my little pleasant uplifting note to end on.
So, just before I let you go, Chris, what's your advice for traders in 2024?
Look, I was thinking about that this morning, and my view is that what will happen is that with all instruments next year, prices will go up, prices will go down, and people will be once again perpetually surprised that prices went up and prices went down. The way you remove that surprise factor is to have a plan. If you have no plan, you really are like a blind person stumbling around a room in the dark. Sooner or later, you will bang into something and it will be really, really painful. No plan, no trade. It's that simple.
Yeah, I think that is brilliant advice. Look, we have had the best year with you on Talking Trading. I wanted to take you through a few highlights and then just a bit of advice over the Christmas period. What did we cover this year on Talking Trading? It has been an absolute pleasure to bring you people such as Brian McAvoy to talk about consistent profits. Chris and I interviewed Lucas. Chris, what did you like
That's
about
my
the interview?
Look, if there was a gold stamp for Trader of the Year, it would be Lucas. Simply because of his capacity to cut through both the gibberish that the market presents, but also the bits and pieces that his head presents. And I can't remember, his wife is a demon coder. And how many systems did he say that he got her to back test extensive? It was something like 500. It was a staggering number. And guess what he came back to? Simple breakouts. And we caught up with him recently, and it's he showed us his account, and it's you just go, bloody hell. That's pretty good, mate.
So to listen to that
mate.
one, I would
Yeah,
suggest
pretty
people
good.
listen to that at least once a year.
Oh,
It's called 3 Life-Altering Trades. I also had fun with Don Dawson and Jordan Malla ripping a trading plan to shreds. And I did one myself without my fellow traders getting involved, called a trading plan horror story. So much fun. Also, I think if you're looking to give yourself a bit of a pep up over the Christmas break, listen to the one that I did with how to get back your trading mojo. So if you've lost your trading mojo and you need a bit of a shot in the arm with energy, that's the one. I interviewed Steve Ward on risk personality, and one of my personal favorites for this entire year was Robert Van Aden. Robert and I have become friends. He is the author of The Badass Trader. God, I love that book. It's an absolute gem. So really go and get his book, The Badass Trader. Mr. Tom Barso, who's also known as Mr. Serenity, is a market wizard. Oh my gosh, I love that man. His book, The All-Weather Trader, is a classic as well. So definitely one to add to your Christmas list. And I also had the pleasure of interviewing Dr. Hank Weisinger. Dr. Hank's advice, which I think is very succinct, and it's actually over on my trading board there: breathe slower. That is such succinct advice and very easy to follow. Now, over the Christmas period, we know from around mid-December to mid-January, volumes dry up. It makes it very difficult to get out of trades, and certainly to look around about now to see when are you going to have a break for yourself? How are you going to take some time off to rejuvenate and to feel that you can bounce again for 2024? I don't enter trades from mid-December to mid-January. If my stops are hit, I exit, but I'm not entering into new positions. I've found that Christmas period is quite volatile in terms of trying to get out. What are your thoughts with that, Christopher?
There is a time to be in markets and a time not to be in markets, and people confuse the two. Well, I shouldn't say they confuse the two. They don't understand the distinction between the two. There is this nonsense notion that you should be in the market all the time. There's simply no evidence for that whatsoever. And I know it's an old mantra of financial planners and brokers where they go, oh, it's time in the market, not timing. No peanuts, it is actually timing.
It really does help to catch that trend. That is what we are completely about as traders. Now, the other thing that I would suggest is something I've been doing for many years. I write myself a letter, and it not only tells me what I've achieved over the past year, but it's also saying what I want to achieve for the year in advance. And I put that letter each year in my Christmas tree box so that I've got all these letters from past years gathering there, and it reminds me to look at my yearly goals. So I do suggest that as a strategy. I've been doing that for years. I think you'll really love it. Now, we do have some amazing guests coming up in our summer series. So the summer series will include people like Jason McIntosh, Jason Graystone, and Dr. Giselle. And we're going to kick off the new Talking Trading for the year on February 14th because I love Valentine's Day. It's so much fun. And I think Christopher's little expression there is quite amusing. We are quite yin and yang. I'm sure that you have guessed that by now.
I was just pondering whether we're still paying for therapy for the people whose trading plans you ran through the shredder.
Oh, I know. It was quite explosive, and it is a terrific lesson in there because you can learn so much from looking at how other people approach the markets. So I do urge you over the Christmas break, yes, listen to our summer series, but go back into some of those past Talking Trading lessons. I am so grateful that you are here listening. It gives me such a focus in my life. I feel like Talking Trading is like therapy. It has not only expanded my views, expanded my heart, but also made me feel so much more a part of our trading community. Trading can be such a lonely game, and I think if you're doing this without support, without getting input, you're actually not approaching this in the right way. There's so much more there for you. And the guest coming up next year, I've already lined quite a few people up. We've got Rik Schnabel. Oh, I adore that man. I was just on his radio show recently. Wiz Buckley, who's a fighter pilot. Luke Mathers. Yeah, Wiz is quite the fascinating character there. You're going to love that one. Luke Mathers, who's the author of Curious Habits. And also, I've just lined up Graham Dosel on credit. So I know you are going to love what we've got prepared for you. Any parting words, Chris?
Yeah, Merry Christmas. All that sort of stuff.
Enjoy your summer and definitely get some time to recuperate and rejig. Look at your trading plan and make sure that you are set for Talking Trading for next year. Have a happy Christmas.
Bye all.